All right, hello and welcome to the GRadulting Workshop Series. My name is Debbie McCuskey and I'm the coordinator of services and programs for graduate student legal aid. So today's focus is tax preparation, and we've got 7 weeks until the deadline, April 15th. So today's session is designed to help you get the ball rolling, to help you get started on completing those forms. So before we dive in, I just want to make sure that you all know about Grad Legal Aid, who we are and what we do. I may have met some of you during orientation, but you don't need an attorney unless you need an attorney, so you may have forgotten about us. So in addition to these workshops, Legal Aid provides really four other areas of service. We provide legal consultations for local issues. We provide legal consultations for immigration issues. We provide advocacy for students who are facing university charges and Title IX issues. And finally, we provide notary services. I am a notary public, so I'll be the one helping you. If you paid your graduate student fee, then you've already paid for our services. There's no additional charge and no reason to hesitate to reach out and ask for help. If we cannot help you, it's likely we will know who can help you. So we often make referrals. So I encourage you to visit our website to find out more about our services and how to request an appointment. So I have a few rules of engagement. This session is being recorded, and I will share a link to the recording and a survey tomorrow. I'd like you to use the Q&A feature for questions, not the chat, but the Q&A feature. That helps us keep track of the questions. If you have questions during the session, put them in the Q&A, particularly if they pertain to what the speaker is addressing. So don't be shy about asking questions. We love questions, and there will be time for questions after the presentation. So let's move on to the speaker. Leading us today is Professor Samuel Handwerger. Woo! Welcome, Sam. Professor Handwerger is a CPA and a senior lecturer at UMD Smith School of Business. He is a UMD undergrad accounting alumnus. He holds a Master of Science in Taxation degree from the University of Baltimore. And finally, and really most importantly for us today, he is the advisor for Terp Tax. What is Terp Tax? It's a free, you heard that, free tax preparation service for students as well as low to middle income folks who live in the College Park community. So, Professor Handwerger, once again, I appreciate you making time to present this workshop. You have been doing this every year, even through COVID, since 2018.
Wow.
Woo!
Wow. Okay.
And and just one more thing, I have to take a moment to commend you and your team of dedicated students for providing the Terp Tax service. I know that your efforts ease that burden for so many students on our campus and really bring down that stress level because it's not easy figuring out how to file your taxes. So thank you again.
Well,
All
thank
right,
you
with
for
that
that.
being, excuse me,
Okay. Uh,
I
Thank you
will
for that
just turn
comment.
things over to you, Sam. Take it away.
All right. Thank you for that comment. I have to say that it's a labor of love from the students and myself, but
Yeah,
anybody who uses us, even if you wind up just coming in and determining that you need to go somewhere else because of complications, you are
yeah.
giving this business students who are volunteers for this program such an opportunity to get experiential learning. It's an incredible experience for them. It's incredible learning, and it goes on their resume. Last night I was listening to one of the students counseling with a client who came in, a student. And what they were doing is showing me the soft skills. They were learning the soft skills. They were learning how to speak to a potential client. And it was just a wonderful thing for me to hear and see what it does for our students. So you get free tax service. You also bring experiential learning to our group. So please come to the door as often as you can. Okay.
Yep, it's a win for everyone. And I will share a link to Terp Tax in the chat. So watch out for that.
All right, excellent. Before we go to the slides, I just want to make one introductory remark in that today's recording, or it is being recorded, but today's
Maybe.
lecture is on taxation for college students, particularly, and those that are residents of the United States, citizens residents. If you are an F1 student and you're here and you're still within your first 5 calendar years, this would not be perfect for you. We have one that's recorded that is it up on your website, Debbie? Is that where they could find it?
Yeah, it'll be in our newsletter. We'll post it on the website and I'll put it in the chat.
Okay, so that would be a recording. We did this last week, and that's for you. If you're here, F1 within your first 5 calendar years. In the event that you're F1, but you're over 5 calendar years, this is your sixth calendar year, this is for you because the issues that we are going to talk about apply to you. You file as a resident. That's what we're going to talk about. So, on that note, we'll go to the slides and take a look at what we got to get started. Let's see now. There we go. All right. Okie dokie. Oh, we're in the right place. All right. There we go. Too many screens all at one time. All
No,
right.
look good.
Yep. Here we go. All right. That's what we're doing. And by the way, Debbie, the reason I've been teaching this for every year since 2018 is because every year the tax law changes. So it's otherwise you could have shown the video from 2018.
Yeah, you can count on that changing every year.
All right, so these are the topics we're going to cover in their somewhat in their order that's labeled here. I'm not going to go through reading them. We'll just go through, but you can take a quick glimpse at what we're going to be doing. And stay, if you want, I can wake you up. I'm going to wake you up now, that's why, because I'm going to tell you why taxes matter for you. Here's why. Many of you work during the course of this summer. Many of you have a part-time job during the whole year or most of the year. You have it had taxes withheld from those W-2s. You may not need to file a tax return, but if you don't file, you won't get those taxes back as a refund to you. And most students have refunds coming to them if they work. If they worked at a full-time job during the summer, like 3 or 4 months, that may not be true because you tend to make some good money during the summer times, depending on your the work you're doing and your level of expertise in your field, but you may be getting money back. So that's what you want to know. So here's where your income needs to tell you that you do need to file. But don't pay attention to this because if you have taxes withheld, what you want to do is you want to calculate what your tax return looks like to see whether or not you have a refund coming. On that note, let's just take a quick look at the tax formula so you get familiar with how it works in the United States. We report on a worldwide tax system. That means all of your income, no matter where you earn it, you pay tax, you report it. You don't necessarily pay tax on it, but you do report it. And what I like to do is to start off by saying you report your income worldwide, so wherever it's earned, and it's the income you report is from whatever source derived, from whatever source derived. So that those are the key words. That's from the tax code. At least today you'll be able to walk away and quote part of the tax code. And that means that if you go home tonight and you open up, let's say, a set of drawers that you bought for your dorm room for this particular semester, maybe you bought it a year ago, maybe whatever, you bought it, and in that room, in that drawer, you didn't notice it before, but in the drawer you find that um, there is $500. $500 you find. And so what are you going to do about that? Well, are you going to report it as taxable income? After all, it says from whatever source derived. And the answer is, I'm going to stop screen and take a look at the hands. You'll raise your hands. How many will report the $500 you find in your drawer of a used piece of furniture that you bought $500. You're going to report that as taxable income? Raise your hand. Okay. And that's the right answer. The tr Since this is being recorded, I got to be careful of how I say this, but at the risk of my CPA license, I would tell you the following. Yes, the $500 is reportable under the strict reading of the tax code. However, you wouldn't be an American if you said you would report it because we know we know that there's a little leeway. You go on the highway, you can get 65-mile-an-hour speed limit. You go up to 75, they're not going to give you a ticket. So $500 is not going to be enforced. But the lesson to be learned is if you add a zero to it, then you got to start thinking about whether it's crossed that 75-mile-an-hour speed zone, and now it may be enforced. So you might be cautious. The tax service, the IRS that administers the tax service, the thing they don't like the most is unreported income. So be careful with that going forward. All right, that's good advice. All right. Oh, I was going to do this, the formula for the tax code. Let's do that. So it's basically you report all your income. We call it the gross income, all the income. First, you report that. Then you're entitled under the tax law, and the tax people, tax preparation people in the software help guide you through this. There's sort of a certain amount of deductions. Deductions are going to reduce the taxable income, or they're going to get to taxable income. So they're going to reduce the gross income. You start with A minus B, and then you get to something called AGI. So these are deductions for AGI, and then you get to AGI, adjusted gross income. AGI is a magical set of three letters because the tax code has lots of provisions that are dependent on whether you can use those provisions or not use those provisions based on the AGI that you have. So that's why we have to calculate that. So we'll call that C. Then you get regular deductions. We'll say those are deductions from AGI. So the deductions up in yonder here are deductions for AGI because they derive AGI. And then the next set of deductions are deductions from AGI, adjusted gross income. So we'll call that D. And then you get to, magically enough, like a rabbit out of the hat, you get to taxable income. Voila. There you are. So taxable income, it tells us what we're going to apply the tax rate to. And don't forget, the United States works on a graduated scale. So the more money you earn, the higher tax rate you pay. But we'll just simply say we'll apply the rate. So it'll be times the rate of E, and it'll get to, we'll skip to the next slides to illustrate it. We'll get to the actual tax. This will be called the tax liability. How much do you owe for the year? So we'll call that F, tax liability. All right, now what happens at this point is you compare that to your withholding tax from your employer, which will be on your W-2, box 2 to be exact. You'll compare that, EFG, there you go. You'll compare that and you'll subtract that from the tax liability to see whether or not you've paid all your tax liability or not. In the event that when you subtract it, you still get a positive number, it means you have to pay. You have some money still due. In the event you get a negative number, that's your refund. And that's why everybody should file if you had a job, even if you're under the income limits, file anyway to see whether you have money coming back. Or if you have money due, you want to know about it because you don't want the government come looking for you 2 years from now and say, not only do you owe the money, but you owe it with an interest and a penalty. And those penalties can be up to 25% and that of the tax due. And that's a pretty severe penalty to pay depending on the amount. Okay, so that's the basic tax formula. Let's go forward. We've almost answered all these questions now, all these vocabulary. Gross income we talked about, adjusted gross income, modified adjusted gross income. We're not going to get into the details there. It's just as it says, it's a modified adjusted gross income for certain other tax sections that say do this with modified adjusted gross income. But you know how the deductions, you saw that reducing to your taxable income. And then we've got tax credits and refundable credits, which we didn't talk about yet, but we will. And we'll just mention that going back to the formula, you look at your withholding on your W-2 to determine whether you're due or a refund. But let's squeeze in one more element, which will include the credits, so we get the credits out of the way. The last thing you do is you look to see if you have any credits, because credits will also reduce the tax if you owe tax. So let's say you owe an amount. Credits, if you have a $10 credit, it will subtract $10 from what you owe. So credits are kind of cool because it's a dollar for dollar reduction, whereas deductions are only as good as the tax rate. Take a look at the formula again. If you have deductions, how much do they reduce tax? By the rate, by your tax rate. And if your rate's low, it means it's not worth a lot. It still helps, still reduces tax, whereas the credits are dollar for dollar. So that's the formula. And after the credits, then you're back to, do I still owe, or do I do a refund? All these all these things here are why you want to file anyway, just to see if you're due a refund from either withholding or credits or both. All right, so that takes care of this slide. Okay. How we doing, Debbie?
All good. No questions yet? Oh, nope. So there is a question.
Okay, go ahead.
If we've received a notification from the IRS that we owe for a previous year with late fees plus penalties, can we ask them for a review of their calculations to confirm that we owe?
Yes, you can. You would ask them for a review of it, and you probably want to ask for if you don't have a copy of the year that they're giving you the tax bill for, you'd want to get a copy of what return they're looking at. So even if you filed it, but you don't have a copy of it, you want to see it. And the first thing we always do when somebody comes to Terp Tax with money due from a prior year is we check out the year, see if it was prepared right. That's the first thing we do. Was there a mistake? Because if there was a mistake, you can change it and show the IRS. I don't know. And they don't care how old the return is. If you show them that that's not what you owe, they'll
Right,
reduce it. So that's a good thing to do.
right, because they're saying that their file did not indicate that they owed. So the student should come to Terp Tax, right?
Yeah, if they use Terp Tax, send us the notice. We'll look at it. If they didn't, still come and we'll help you figure it out.
Okay, thank you.
Thank
That's it
you.
for now.
All right. There's what's called a filing status for residents of the United States. You file either single if you're not married at the end of the year. The key is the last day of the year as of December 31st. If you have head of household, means you have a child or some kind of dependent living with you that you're responsible for from a financial standpoint. If you're a qualifying dependent, you might be filing single, but you'll also check the box that you are somebody else's dependent. That'll change a little bit the way you get taxed as an individual. Most of us students here are qualifying dependents being taken care of financially by either a parent or guardian, as the case may be. If you are married, then you can file jointly, and that can reduce your taxes a little bit more because the rates of married filing jointly are a little better. Nevertheless, uh, you have to choose the right filing status. The IRS has a really unique little decision tree. You go in, you ask one question, they ask you another question. It keeps doing that, and it'll help you to figure out your filing status. And of course, Terp Tax will do that too. What these all matter is that it will tell you what rate of tax to pay on your income because the rates change based on the status you are. Head of household has very good tax rates. Single, not so good. Married is a little bit better than single, but it's just the way the tax code works with the rates. Don't worry about it because it is what it is. You have to file under your status, however it's defined. Now, when it comes to those deductions, go back to that the formula. We show these deductions right here from AGI to get the taxable income. What are these deductions? Well, most students don't have deductions that qualify to reduce that AGI, that adjusted gross income. But everybody gets a standard deduction according to tax law, meaning it's automatic. And so the minimum you get is the standard deduction. When you're single, you get 15,750 right off of your adjusted gross income right away, as long as you're not a qualifying dependent. Once you're a qualifying dependent, this changes, but it doesn't change poorly for you. We'll go through it. So here's the disclaimer. Claim as a dependent, your deduction becomes your earned income plus 450 capped at this amount. Let me explain that with a little example before you all panic, because most of you are dependents. And so you're not getting this standard deduction right off the bat. The standard deduction this year in 25, if you file a 25 return, was 15,750. Suppose you're a dependent. You're a QD, qualifying dependent. I never used that expression before, but we'll do it now, qualifying dependent. And so what happens is you don't get the standard deduction. But if you worked and you got a W-2 of, let's say, $4,000, well, without that qualifying that deduction, because you're a qualifying dependent, without the standard deduction, I should say, it looks like you're going to pay tax on this. And that's like a, oops, I don't want to pay tax on that because that might be 10%. So here's the way it works. The way it works is you get a deduction with earned income, and we'll call it EI. So this is earned income. You worked for it. W-2 income is earned. So now what you get is you get 4,000 towards your standard deduction. You don't get the whole standard deduction, but you get 4,000 plus $450. So you already have 445.50, and so you want now you can see. I love this. Right now you can see that since you're going to get this standard deduction, it means that if there was any kind of withholding tax here, you're probably going to get that back, absent any other taxable income that you might have. So if you don't have much other taxable income, you're probably going to get it back because this 4450 is going to reduce you almost to zero. It's true, it's not the full standard deduction, but you don't need it. You don't need it. You want to just get to the zero taxable income, and then any withholding on that W-2 is coming back to you as a little bonus, a tiny bonus. All right, so standard deduction is every year, it goes up next year. In the event that you're not a qualifying dependent, you can be looking at this kind of number in 26 as being your tax-free number, where you can earn that much income and still not have to pay any taxes. Of course, to head a household, you have to have a qualifying dependent in your household. So you're looking at probably if you're after school, you've graduated, and you're working, that could be possible. It could be a sibling or somebody, a relative. That's the tax formula. Now, the neat thing about what's going on in the United States these days is these numbers are higher than they ever were from thanks to the 2017 Tax Act. These numbers jumped way higher than they used to be, and therefore most people are not looking to do the other alternative. The other alternative, instead of a standard deduction, is what's known as itemized deductions. But with the standard deduction so high, most of America now is using the standard deduction. In the event that you're out working for a couple years and you buy a house and you're giving charity and you have state taxes and real estate taxes and mortgage interest, then you might have an itemized deduction total that is greater than the standard deduction, and you can take the higher of. You always just take the higher of. That's the way it works. As a student, it's not expected that you would have much of an itemized deduction. So it's really cool to get the standard deduction. And by the way, on this little illustration here, the highest amount you can go up to with this earned income and 450 is up to the standard deduction. So once you get above 15,750 of earned income, once you go above that with your W-2, now you may be looking at some amount of tax applied to your taxable income. You might have some. Education tax credits. This is a very important area to take a quick look at from the standpoint of many of you are paying tuition. Even if you're borrowing, you're paying tuition. If you're getting a scholarship, that's a different story. But if you're paying tuition in any shape or form, or even if your parents are paying the tuition, the education tax credits are something to consider. If your parents are paying it, then you want to talk to them about, are they using those education tax credits? Because you may be able to use it depending on, again, on your tax situation. So let's take a look at what it is. You've got two different types of education tax credits. The first one is for your 4-year people. These are your 4-year undergraduate. It's called the American Opportunity Tax Credit. It's the biggest one of the tax credits in terms of its richness, and it's for your first 4 years as a full-time college student, full-time being 1 semester per year. So for the first 4 years, if you're in college for even 2 semesters, that's fine. If you're in college for 1 semester, that counts as a year. So it doesn't necessarily mean until you get your undergraduate degree. It just means 4 calendar years. So that's how it works. So for four calendar years, this is the credit opportunity to you, whether you graduate or not. How it's declared or how it's calculated is it's 100% of the first 2,000 of tuition. So it's not a lot of tuition that has to be paid. And then 25% of the next 2,000 up to a maximum of 2,500. So it doesn't look like a rich concept, but here's the deal. Here's the deal. 40% of it is refundable. What does that mean? Let's take a look at the little part of the formula where we got the credits. You wind up computing that tax after you compute the tax rate. And let's say it's $1,200. And let's say it's $1,200 after withholding taxes. So this is your net. This is what you owe. And if you come up with a $2,500 credit, that credit will reduce this number dollar for dollar. So first it'll reduce the tax to zero, but then the next $1,000 is refundable, even though you don't owe tax. So this will, I'll write it here, I'll say the IRS will write you a check for $1,000. Beautiful. Hey, I'll take it, right? So you can see that this AOTC has a lot of value to it to check it out to see, are your parents taking it? Fine. If they're taking it, it means they're saving most likely 2,500 because you only have to spend $4,000 in tuition to get the maximum deduction. Remember, the first 2,000 is full, 25% of the 2,000 above that gets you an extra 500. So you get up to the did I say 4,000? You get up to the 2,500 right away. Oh, I said with $4,000 of tuition. Okay. I'm just an accountant. I don't do math. All right, so 4,000 of tuition, and you can see that you get the maximum credit. Not a lot of tuition required considering certain schools' tuition rates. I'm not mentioning any names. Make that a note in the recording, Debbie. I'm not mentioning any names. Okay.
Got
All
it.
right. So that's a pretty valuable credit. And it does phase out, which is why your parents may not be able to use the credit. As your income goes up, then you may not be able to use the credit. For example, take Jake's parents. Jake's just a name. They earn 85,000 of that MAGI, that modified adjusted gross income, and it's one parent, they're single, and they're 5,000 over the 80,000 threshold. We're not going to go through all the details, but what we're going to say is their credit is going to get reduced because they're making too much money. The credit is made as an incentive to go to school for people who can, I wouldn't say ill afford college, but it's a struggle for them to pay for college with today's rate. So what would happen here is this particular person would only get to use a certain amount of the credit, whereas a person, if the qualifying student was below and got the whole refund back, that's what this example shows. So between the parent and the student dependent, because the student dependent is making a pretty good amount of I'm sorry. This is the phase out example. I was going to use the Maria over here as a sophomore earning that kind of money, but she wouldn't be earning that kind of money. So let's do this one example one more time. Sorry about that. I was getting carried away because the punchline is coming up, and that's what I'm getting carried away with. So here you got two examples. One where the parent is below the 80,000 and they can use the whole credit, they get the refund. Here, if you just go above the certain amount, in this case, Jake's parents goes above it, and so they don't get much of anything. They get a little bit of a tax break, but they don't get the refundable portion. That's the two examples. But here's the deal. Punchline coming up. Spoiler alert. All right. So in the event that your parents can, because of their income, get zero credit, so they don't get anything back, you have to look at your say, what happens if I were to use the credit on my return? Now, to do that, your parents have to give up the dependency. They have to say to the IRS that you're not going to claim you as a dependent. It doesn't really hurt their taxes all that much. So not claim you as a dependent. If they do that on their return and you have enough income where you're starting to get money back from the credit, the AOTC credit, then you want to have a serious conversation with your parents and perhaps their accountant about doing that because This probably, not claiming you as a dependent, probably won't cost them much. And the refundable or the amount that you will get back reducing your taxes, plus any refundable, probably will exceed any loss on your parent's side. So that needs to be calculated. I can't give you a rule of thumb on that, but you need to calculate it out to see because every situation could be different. Your amount of income is going to certainly be a big part of that, and the parent's income as well will be part of the calculation. But it's something an accountant, a CPA would do.
All right, Sam, when you take a breather, there are a few questions that came in.
Fire away.
All right. So someone says they are an independent graduate student, and I think most of our participants are graduate students, not undergrads.
Okay.
Um, and this person files independently. So they say, how does this change things for me when I'm filing? Do I need to specify that somewhere?
But if you're a
And
grad student,
they are an independent grad student and they file independently.
okay, then you're going to check the box as single. You won't check the box as being a qualifying dependent. So since you're not a qualifying dependent, all the discussion I just had about the t education tax credit between parents, guardians goes away because it would all be on your return. So it
Right.
would just follow you. If you're paying the tuition. If your parents are paying the tuition, even as a grad student, you can still use that. That's another, wow, I forgot about this one. This is great. This is great. If it doesn't matter who's paying the tuition for you, you can still take the education credit. You just have to coordinate it with whoever's paying the tuition to let them know you're taking the credit and they don't take the credit. Can't double dip. But that's another great one. So even if the guardian or parents are paying it, you can qualify, you can take the education credit, and it would depend again, can your parents use it? Maybe their rate's higher, maybe it's better for them. You would coordinate it, even if you're a grad student.
Okay, sounds good. Next question is, we have someone who's paying into a 529 plan.
Coming up,
Um,
or coming up with that.
you're
Oh, but you
coming
can
up.
ask the question.
Okay,
Go ask the question.
you
Sorry.
want it? Okay. So they're paying into a 529 plan for themselves, funding their own plan.
Hmm.
And they have a credit from that for the following tax year. Do they still need to use the AOTC piece when they file taxes?
I'm not sure what they mean by they have a credit. Are they using the 529 plan to pay for the tuition?
Let's give them a second to you. Yes, they say yes.
Okay, so if you use the 529 plan to pay tuition, you're not really paying the tuition. The 529 plan is paying it, and so you can't take the credit for the amount paid by the 529. If you pay any of it yourself, that can qualify you for the credit, but the 529 plan has tax advantages, so you're getting the advantage there by having that plan pay for it.
Okay, they said understood. Thank you.
Okay. May not be the answer, but I'm just the messenger.
All
Okay.
right,
All
that's
right.
it for the questions.
Okay. So again, the AOTC, what qualifies for the expenses that you can use to figure it out? It's important to just take a quick look at what they are, and you can see they are indeed qualifying expenses. They're the things that you have to pay for to go to school. It's not your dorm, it's not your food, it's the fees required to be enrolled in the school. So these do not count. But that's okay. For the AOTC, 4,000 in tuition to get to the maximum, no problem. All right. What if you're a grad student and you've already been taking the AOTC for 4 years, so or you're not in a degree uh, program? What happens to you? So here's what happens. You are eligible for what's called the lifetime learning credit. That's we see here. You're eligible for that. No matter what you do, take one course, take two courses. It's unlimited years. It's for tuition or cost of for credit courses or education at any school that is qualified under the government loan programs, and almost any school qualifies for it, and you will get a credit against your taxes. You don't get a refundable portion, so you can only reduce your taxes to zero. You can't go below zero and get some of the refund. It's a maximum of 2,000. It's based on a 20% of the first 10,000. That's how you get up to the maximum. So it's not as rich as the AOTC, but it's still better than not having it all. Again, first 4 years, the AOTC is available to you, and then after that, the lifetime learning credit. And it's really a great way to for the government to give everyone an incentive to continue our education and make us smarter as we age. Just a quick comparison, 2,500 here, 2,000 here. This is a lifetime learning credit on the right. Refundable up to 1,000, no refundable amount here. 4-year max per student, unlimited years here. Undergrad only. So there's your another limitation. It's not just 4 years, but you got to be an undergraduate. So no degree requirement here. Here you have to have a degree requirement being an undergrad. So it's really meant for that at least half time one semester. One course does it here. I think you get the gist of this. Okay, that's education credits. Deserves to be looked at. And now we're going to look at student loan education savings benefit. This is going to be rather quick because most of you are not paying your student loans back. But if you are, you can deduct up to 2,500. Again, a deduction off adjusted gross income reduces the taxable income, reduces your tax by the amount of the rate of the tax. So you can deduct up to 2,500 in whatever student loan interest you pay during the year. You'll get a form for that. It'll be a 1098, something along those lines, some kind of 1098 form. It'll tell you what it is, how much interest, it'll tell you how much interest you paid on your student loan. So you don't have to guess on it or calculate it. And you don't have to itemize, you get the deduction anyway. So you get your standard deduction and the deduction for the loan interest on your student loan. If your parents are paying the student loan, they can take that deduction. That's good to know. And it had to be qualified education expenses. So what you're getting out of this is you can see there's a lot of rules when even though it says education credit or reduce interest deduction on student loans, still got to take a look at the rules. Good news is Terp Tax, of course, does that. Most softwares do it as well. Okay. All right. And let's see. And there are also income phase outs on that. So once you're earning enough income, then you reduce the amount of student loan interest you can take as a deduction. The tax code is progressive, taxing higher and higher rates on those people who make better money. All right. We're not going to go into this in too much detail. I just want to mention, won't go into the detail, but just mention, and that is that there's now, for many years, there was an exemption from taxing income of a student loan that was forgiven based on whatever program you were in. Some people were in a program, if they worked for the Coast Guard for 5 years, their student loans were forgiven. That goes away in 2026. And so it doesn't affect your 2025 return, but it would affect going forward. I would suggest that if you're having student loan forgiveness because you're teaching as part of your program and you get some amount of your student loan reduced because you're teaching or like Coast Guard and all those kinds of things, then you would want to probably talk to somebody about what it means for your tax in that year that the forgiveness is happening. So there's just a word to the wise for the 26th year and forward. It's called critical change. It's sort of like the snow, the weather forecast for the snowstorm we just had. It's like a critical announcement, all in red. All right. 529 plans. Here we go. So these are really good to put money aside for education because they grow tax free. That's the key of these. They grow tax free. What that means is they'll earn interest, dividends, perhaps capital gains, and you won't pay tax on that as you normally would while the money's in the plan. If the money comes out of the plan for education costs, qualified expenses for education, it comes out tax free. So the 529 plan, which is a plan for when you're young, or somebody's young, a dependent of yours is young, and you want to put money aside in a tax favorable way that can actually escape taxes, this is the way to do it. If you were the beneficiary of a 529 plan set up by your grandfather or your parents or both, then you can use what's in the 529 plan as a tax-free distribution for the qualified expenses to go to school. Is that better than the credit? Well, yeah, because you've saved taxes on all that growth for whoever put the money into the plan to begin with. And that's a nice thing to do because it puts the money to good use for your tuition and saves whoever it is who put the money aside from having to pay taxes on it. And sometimes the people putting money aside for you in a 529 plan would have been taxed at a pretty high rate. So you can see the result is there's more money for you. It otherwise would have been reduced by tax as it grows. Think of the compounding of interest. Every year it compounds, but what if every year we take away 10, 15% to pay taxes? So it's going to grow a lot less because the taxes are coming out. So the 529 plan doesn't take that out. All the investments compound completely. And as long as you use it for the education of somebody, along the way, then it comes out tax-free. And they've added a couple years ago, they added K through 12 tuition along with community college and regular college, grad school, you name it, any education that's considered a qualified education expense like we have here. For this, just think of the education credits. What was ever in there applies for this 529 plan. All right.
Hey, Dan, can
Yes.
we go back to the lifetime learning credit? Quick question. Can you claim the lifetime learning credit for massive online open courses such as Coursera Plus or Udemy subscription?
The short answer is no. Sorry about that. It's got to be some type of qualified educational institution, very similar to the institution of the University of Maryland, or that kind where it's registered, or what's the word that we use for our school? We are considered not peer reviewed, but we're in the I forgot the word for that. You know,
Accredited.
that's it, accredited. There, that's good job, good job. When I went to Maryland, it might have been accredited, but it didn't didn't deserve it. That's a long time ago. Don't tell anybody. But now it's definitely accredited in the right way. Okay. All right. Yeah, so it has to be accredited. Those are not. Any other questions out there?
There is a question. It's about software for filing taxes. So, this person is an international student living in the US for 7 years. They used TurboTax last year, but this year they have the option to use Glacier because it is the one the school uses. So, do they have the option of what software they can use, or do they need to use the one the school offers?
They use whatever they want. However, I want to caution them that if they've been here 7 years, 7 calendar years, they are now counting their days to determine whether they're a resident or not. So if they're here all of this, say 25, they are definitely a resident for tax purposes. And absent any tiny exception in the tax code, they are going to file a 1040, Form 1040, like everybody here who is a resident or citizen files 1040. That's what they're going to need to file, not 1040 non-resident, not 1040 NR. So if they get into the software and it's going to do a 1040 NR, get out of there, either come to Terp Tax to make sure that they cannot use the 1040 NR or just file the 1040.
Okay, sounds good. Thank you.
All right. Okay. We're just going to take a breeze through a couple other sections given the time. I'm just going to point out interesting salient points. I think those words mean the same thing, interesting and salient, but it's things that you need to watch out for. We can't go into detail because most of these topics could take an hour a piece, but let's talk about what we call the work gig economy and other deductions. In the event that you work as, let's say, let's get it where we got it here. Hold on. Well, I thought I had a slide that was going to name all the gigs, but here, you know, the gigs. The gigs could be working for DoorDash, could be working for Uber, places like that, where you are going to be considered to be an independent contractor. I'll just abbreviate it. They're not going to give you a W-2. They're not going to withhold taxes. As an independent contractor, you get a form from them called Form 1099 NEC, which means non-employment compensation. It's basically saying you are in business for yourself, buddy, which is not a bad thing, but they're not withholding taxes. You need to be aware of that before you start working in any of the gigs out there, because if they're not going to withhold taxes, you need to be cognizant of you may have to pay estimated taxes in order to avoid getting a penalty, and those estimated taxes need to be paid quarterly under the tax code. And those quarters are April 15th, June 15th, September 15th, and then January 15th of a calendar year. And the result of all of this means without any withholding taxes and having to pay those estimated taxes, you're now your own boss. So you're going to be open to be able to take certain deductions that other people can't take. What are some of those deductions? Home office deduction. You can take some of that. You can take your car if you're paying for your mileage, if you're paying for it. You can take travel expenses. There's a whole host of expenses that you might be able to reduce your income. So you need to know that exists. But one other thing does exist, and that is if you're a gig person, not only are you subject to the income tax, but you just learned about the fact that inside the Internal Revenue Code, there are two taxes. One is the regular income tax for ordinary income. And in today's world, I don't think any income is ordinary. And then there's a tax called the self-employment tax, which is the Social Security tax that you usually pay as an employee, but as an employee, it's also Medicare. As an employee, you only pay half. The rate you pay as an employee is 7.65%. But when you're a gig worker and you're not withholding taxes and they're considering you to be independent contractor, then you pay this times two because you're your own boss. So it comes out to 15.3%. So that means that you really want to find what those deductions are, because now it reduces ordinary income tax plus the Social Security. So you have both taxes, one and two, if you are getting a 1099 NEC. So find that out before you start working. They might give you an independent contractor form to sign, but that doesn't mean you're independent. So you might want to check with Terp Tax, check with me to see if you really are independent and have to file as an independent contractor. Because if you don't have many deductions, you're going to pay tax on every dollar they're giving you at both tax rates, the ordinary income rate and the Social Security Medicare rate, times at the 15.3% rate. It's okay if you have lots of deductions. It's not okay if you're not supposed to be an independent contractor. And I'll just say this, when it comes to are you an employee or are you an independent contractor, you can look at my blog. Maybe I'll send it over to you as well, Debbie. I got it. I wrote an article just recently. It comes up every year. I wrote an article recently about what are you? And it makes a difference on how you get taxed. So a lot of people, a lot of employers out there try to get you to accept to be an independent contractor agreement because it saves them a lot of taxes and a lot of work. But you don't want to do that if you truly are an employee under the law. How do you determine that? It's sort of like good luck, but read my article and that'll help. All right, moving along. If you are your own employee, or even if you're not, even if you're employed as a student, don't forget to look at whether you qualify for an IRA based on your income and your tax return. Don't forget to look for that, because if you have extra money lying around, the IRA limit is $7,000. This is a great way to save. Why? Because the money that goes into the IRA will grow tax-free. We already encountered the brilliance of having your money grow tax-free. It compounds so much more. And there's two types of IRAs. One's a traditional, then there's the Roth IRA, which probably is a good deal. You don't get a deduction for it, but it grows tax-free and it never gets taxed as long as you keep it in there 5 years. So that's probably, I can't say definitively, there's no right or wrong to which kind of IRA you take. But these are vehicles that allow you to put money aside and grow tax-free. The same thing with an HSA, not available to our undergrads per se, but definitely when you start working, you're going to want to look into that. When you start working, don't forget to go to HR to ask about these two things. Do they have an HSA plan you can put money into? Do they have a 401k? You want to put money into these, even though it's going to hurt your ability to pay for your expenses because the money goes into those plans. But you really want to start putting money away for retirement and health care costs later on in life, particularly under the tax-free growth. It's worth it. And also, some of the employers will be matching how much you put in or giving you an extra amount if you put in money. So you don't want to lose that tax-free money from your employer. So you got to look for what's called the match, the employer match. Just I'll do this quickly. That means they're putting money in for you. It's like getting a bonus. So don't miss that. Go to your HR department when you first start working. Other deductions that can help students. Well, if you're teaching K through 12, but you're still in school, you can get a small deduction for any out-of-pocket supplies you buy, maybe to give candy, not candy, food, healthy food to your students. You may have medical costs. That's part of the itemized deduction. Chances are, and God forbid, you should have high medical costs. And these are all itemized deductions over here, mortgage interest, charitable contributions. So your standard deduction probably will beat those. One thing to point out, though, I think on this slide is that in 2026, there's going to be an exception to charitable contributions, meaning $1,000, even if you don't itemize, even if you're just taking the standard deduction, you can deduct that off your taxable income. $1,000 given to a qualified charity, which is a 501c3, like Terp Tax. Ooh, did I say that? Okay, like Terp Tax, 501c3. If you gave a charity like that $1,000 or something less, then that comes off your taxable income in 2026. So you haven't lost anything yet this year. And you can still take the standard deduction. All right, we're almost done. Forms, deadlines. Okay, forms you're going to want to see. Do you have a W-2? There's your 1098-T about your tuition for your education credits. 1098-E is for your there it is. Student loan is 1099-E for education loans that you paid interest on. If you did start paying it back, you'll get one of these. If you are a gig worker or independent contractor, you'll get a Form 1099 NEC. These are all things you need when you sit down with Terp Tax or a tax preparer to do your forms. 8863 is you don't have to worry about it. You don't get this form. It'll be used on your tax form. And this is what you're going to file based on the type of students that this lecture applies to, the Form 1040, meaning resident of the USA. So those are most of the forms you would want to get. The tax deadlines won't go into all the detail here, but the first deadline is April 15th. If you can't make that, just get yourself, it's very easy. You could do it online yourself. You could get Terp Tax to do it for you. Get an automatic extension. It's not automatic that it happens automatic. You still have to file a form, but it's automatic. You don't have to explain why you're getting the extension. It's like you don't have to tell the teacher why you missed class. You just tell the IRS, I missed class. I need a extended date of October 15th, and they'll give it to you. But do it, because if you don't do it and you owe taxes, there could be some additional penalty and interest to pay. So word to the wise, make sure you file the extension if you need so. All right. Free tax help, that's Terp Tax. It's we're in room Monday through Thursday. You need to make an appointment, but we're in Van Munching Hall, room 3505. If you have just a real simple question, I'm usually there, not all the time, but somewhere between 7 and 9, come by and just ask me a question. We might not be able to get to your return, so make the appointment. You get your documents together. Terp Tax, the online system will work you through everything you need to do. Mistakes, don't file. That's a big mistake. Even if you have zero, I'm a big fan of filing a zero return just to tell the IRS you thought about it. Sort of like telling the IRS, hey, I know you're out there. It's like waking up and recognizing the deity of the universe. So I don't think it's a bad idea, even if zero. Claim yourself don't claim yourself if you're a dependent of your parents. Make sure you say you tell the IRS on the tax form you're a qualifying dependent so you don't misstate your return. Don't forget that scholarships and grants may be taxable. We didn't do this. Let's do it before we finish. Let's do it now. Scholarships and grants may be taxable. How will you know? You're going to get a form. This is important. Everything's important, but this is important. You're going to get a form 1098-T. In box one is going to be the tuition you paid. How much did you pay? In box five, it'll be your scholarship. If box one is greater than box five, no problem. If box five is greater than box one, then it's an indication that some of your scholarship was for non-qualified expenses, meaning room, board, entertainment, clothes, things just to help you live, not for your qualified tuition and your qualified expenditures. And that's the difference. It could be taxable. So box five minus box one, you get a positive number, that's the taxable amount of your scholarship. So don't forget to look at that. So you bring that to whoever is going to prepare your taxes or put it in your tax software if you're doing it yourself. And let's see, there's your international students. We can skip that. I think we can take, I think we have to take questions because we're basically done. Let's see.
Yeah, we've got several questions in the queue.
Okay, fire away.
All right, diving in. All right. Okay, we have a first-year PhD student who has an assistantship that they started in August of 2025. And to use Terp Tax, will they need both the W-2 and their 1098-T forms? They have received both of those documents.
All of the above.
Okay. Bring any and all documents. Even if you're not sure that they'll need them, bring them anyway.
That's good advice.
Yeah. Okay. So, Sam, will you repeat what you said about charitable contributions? An accountant told this student that they couldn't claim their donations to nonprofits unless they donated $10,000 a year.
Well, that may be because of the standard deduction,
Hmm.
and that would be that would be an answer specific to that student. I can't, that number doesn't ring a bell to me as being a correct number just for anybody. But under up till 25, you would take the standard deduction being higher than your itemized deductions. Your charity up to 2025 goes into itemized deductions. So chances are that the accountant, whether the 10,000 was right, was giving the right answer for the student that they couldn't use the charity they gave. But in 2026, you can use up to 1,000, regardless of whether you itemize or take the standard deduction. So it's a new incentive the United States government is saying to everybody, hey, give to a 501c3 charity because you will reduce your taxes by it. So in this year and going forward, until they change the law again, look for those charities that are dear to your heart. Give up to 1,000 unless you know you're going to itemize.
Okay, sounds good. Thanks. Next question. Can I claim the LLC?
Well, I would like to say yes. I don't know your situation, but if you're in grad school or if you're taking any courses whatsoever, then the answer would be yeah.
Okay. Next question, and perhaps our last. So this student moved out of state during August 25. Would their tax reports be based off of the jobs that they held from a different state, as well as the assistantship that they now hold as a grad student?
Okay. Well, you might have noticed in my slides, I didn't talk about anything other than federal taxation. And the
Yeah.
reason for that is once you start bringing the states into it, is my head starts to spin. It depends on the state. When we teach the state and local tax, I tell the students DOTS, which doesn't mean Department of Transportation Services, it means depend on the state. Every state's got different rules. Generally speaking, when you work inside a state, you're going to have an income tax requirement. If you're there just working, even if not a full year, so you're going to have to probably file the key is whether you're going to have to file will be based on what your W-2 says. The W-2 from the employer may say you worked in Virginia and it'll give an amount. And then it may say you worked in Maryland and it'll give an amount. And it's breaking down how much you earned in each state. So depending on what the W-2s tell you, if you got W-2s from various employers in different states, that you have some complication in filing your state income tax returns. And not to, this is not for profit, the Terp tax. I would say you're going to want to use a service like ours because we
Yeah.
can do all 50 states in DC, but it's not something for the, if you don't mind wasting a lot of time trying to figure it out on your own, you probably could. But I don't think you want to waste that kind of amount of time.
Right, right. All right. Good answer, Sam. Well, it's 1:31 and I know you have to teach a class. Do you have time for one more question or do you
Yes,
need to run?
please, please, let's try it.
Okay. Um, so this person says, oh, thank you for answering that about the state tax. I was wondering that. I think I'm going to set up a meeting with Terp Tax. Okay, terrific. Smart move. Go to Terp Tax.
Yeah.
And, like anything, at 5 minutes after the workshop, you're going to come up with 10 questions. Go to Terp Tax,
Yeah.
right?
Yeah.
All right, well, let's wrap things up, Sam. Gosh, I can't thank you enough for joining us for another workshop. Terrific information, so well explained and laid out. Thank you.
You're welcome. And I should have said this at the beginning. I forgot about this particular caveat. No less than a great genius of the 20th century, Albert Einstein, was quoted as saying to two people in public, so we're pretty sure he said it. He said the most difficult thing in the universe is the income tax. So I feel like a astrophysicist right now. That's what I feel like.
Yeah, that's saying a lot. Ay. Well, again, Sam, you're always on top of taxes, and I know you do so much for our students. Again, thank you.
Well, thank
And
you all for thank
yeah,
you for being here, and I look forward to answering any questions that you might have as time moves on. You can email TerpTax, you can email me if you can find my email address, which is probably pretty easy to do. I'll be happy to try to take a look. Thank you.
all right. And thank you everyone for attending. Please fill out that post-workshop evaluation. It will be in the email that you'll get from me tomorrow. And watch out for Grad Legal Aid's newsletters. We send them out a week before every workshop so you know what's coming up and you don't miss us. So that's it. Have a great week. Have a good day. It's going to warm up tomorrow. And let us know how Grad Legal Aid can help you. Bye.
All right, take care, everybody.
Hey Sam, thanks.
Thank you.
Would you be able to send me